So when the yen falls, which it has fallen quite sharply, everyone gets richer.
In Europe, the mortgage payment for consumers is going up, and that will have an impact on disposable income and consumption much quicker than what we will see in the US, because all the mortgages are floating rate.
So as you can see, the fertility rate is too low, working age population is shrinking. They are now finally battling the third E in what is called the impossible trinity of demographics.
Hello and welcome to Open Dialogue by Axis Bank. In our last episode, we spoke with Neelkanth and Ashish on the happenings in the US and China. Today we'll continue our discussion on the rest of the world. Join me for a special episode on these topics. Moving on to maybe the third big constituent of the global economy, which is Europe. Again, lots of quote unquote negative news coming out of that, right? Whether it is economic, political. So what's happening in Europe, Neelkanth?
See, Europe is also going through a problem with demographics, right? So as you can see, that the fertility rate is too low, working age population is shrinking, and they are now finally battling the third E in what is called the impossible trinity of demographics. So there is ego, economy, and ethnicity, right? So you can't have all three. Ego means that, as you become richer, people tend to have fewer kids, because having kids and bringing them up, as all of us know, is a lot of effort, right? And so you have to sacrifice your own careers, and generally the women have forced to end up doing that. So you have to sacrifice ego if you want to have a lot of kids. If you don't do that, then you let go of economy. If you want to keep ego and economy, you have to let in a lot of immigration, which is ethnicity. So you have to so all three cannot be maintained.
Right.
For a long time, the Europeans were compromising on the ethnicity side. So there was a lot of immigration happening, legal and illegal. And now you can see right-wing movements which are against it. There's a lot of protest. So I think Europe on the demographic side has significant issues. I think because of the structure of those economies, which are far more, I would say, left-wing than what we have seen in the US, the process of creative destruction is a lot slower. than so if your TFP is not improving, again, capital formation is very hard to do, and populations are not growing very rapidly, and then you have this significant uncertainty on the borders, right? And so it's very unlikely to be doing very well. It was also very dependent on China. So the classic summarizations, I generally hate these summaries, but it's important to remember that they still matter. That having cheap energy from Russia and selling a lot of capital equipment and technology to China, I think all of those things are no longer going to support them. So now they also have to create the fiscal union and solve a lot of deep political problems. And when we think about state elections in India, at least they don't matter too much for what's happening in Delhi. I mean, not directly, but in Europe they have a big impact. So in India, it sort of stalls policy making for a few months. There, it can totally distort policy making for the next few years if the political outcome in, say, Italy or Spain or whichever parties. So I think Europe is going to continue to struggle. Having said that, I must say that in all the discussion we've had so far, it's important to remember that none of this is predicting a collapse.
Right.
So we are talking about very weak growth.
Right.
The biggest debt problems are in China, but there it's all SOE banks, it's the state. So very disorderly collapse is extremely unlikely. So what if in our worldview we should not fear something which is completely uncontrolled? There is a risk of accidents which is there because of high interest rates and failure of firms potentially next year. But what we should anticipate is sustained period of low growth rather than a very disorderly collapse.
Right. Sorry.
Europe, one more thing we have to look at, particularly on the consumption side. Europe is very different from US, right? So while Europe also has seen rate increases, the challenge here is that the mortgages are floating rate.
Right.
In US, people are locked into fixed
Fixed
rate
rate
mortgages at least for a period of time, right? In Europe, the mortgage payment for consumers is going up, and that will have an impact on disposable income and consumption much quicker than what we will see in the US, because all the mortgages are floating rate.
Right.
And Europeans are actually, because fiscal discipline is kind of drafted in almost into their constitution, so it's very hard for them to sort of keep raising the debt ceiling and political grandstanding and all that. So, which is why you're seeing that they have fallen into recession a lot faster. And then there is the issue of BREXIT, where one reasonably sized economy, which is still a small island, has decided to break away and in effect create significant disruption to supply chains.
Yeah. Great. So we'll move to India in a minute, but before that, just Japan. And they seem to be in a completely different world, right? Like everything is counter to what the rest of the world is doing. What's the thinking there, and what's kind of happening there?
So Japan has again on that triple E, that ego, ethnicity and economy, I think the ethnicity issues there are much more severe.
Of course.
They are at the margin starting to relax a bit, so you can see a lot more of Chinese, Vietnamese, so that's starting to relax a bit, but still I think from a workforce growth basis, I think there is a problem. The big change there is that after a long time, there is some signal of inflation.
Right.
Now, the thing about Japan is that, given where they are, and a lot of their assets are actually sitting outside Japan. So Japan is one of the most, or not one of the most, it is, or the percentage of GDP, the highest net asset owner in the world.
Correct.
So when you look at international investment positions, so as a country, how much do you own of the rest of the world, and how much does the rest of the world own of you? So India is has a net liability.
Correct.
US is minus 50% of GDP. Japan is plus 70% of GDP.
Right.
So when the yen falls, which it has fallen quite sharply, everyone gets richer. The corporates get richer, the individuals get richer. Their pension fund
In Japan.
50% in local currency terms. So in Japan, 50% of the assets of their pension fund are outside Japan. So when the yen falls, they actually become richer. So
basically, they have $100 of, let's say, assets outside, and yen to the dollar is, let's say, hypothetically 1:1. It becomes 1:2. So in yen terms, you're
feeling much richer, right?
Yeah.
So you feel much richer, and so the initial response to a currency depreciation is, oh my God, this is a slap in the face. This is economic embarrassment. But 1 year later, once that immediate shock is gone, you say, I'm actually richer.
I have more money.
Right? And so I think Japan will be fine. I think, and you've seen that. So generally, like Japanese corporates, a lot of the assets are outside Japan, right? So I think they should be okay. So again, Japan is neither going to accelerate sharply, nor is going to collapse in a big way.
Right.
At the margin, and this is something that we still need to investigate, the fact that they've let go of what they call yield curve control.
Yes.
Right. So they were targeting. So generally, central banks in the world target short-term interest rates, overnight interest rates, 1 week interest rates. They were targeting 10-year interest rates, right, which they called it yield curve control. That the 10-year bond yield was being targeted. They recently, you must have seen the headlines, have allowed this to climb up to 1%. This, while for Japan is a reflection of the fact that inflation is finally starting to, so they're moving out of deflation, which was, as you rightly said, they have different problems. But the 0% long-term interest rates that they were sustaining for a long time was a cheap cost of funding for financial markets globally.
Right.
And the fact that these numbers are starting to go up Right now, we are still seeing the Bank of Japan trying to stabilize the markets because it's a very big change in stance. But it's a question mark on how this affects the cost of funding in financial markets and therefore asset prices, because the carry trade using, or rather, borrowing in yen at 0% and then investing elsewhere was very common.
Right.
So
it was, I understand, one of the largest
correct.
kind of
Exactly.
books
So,
run
so
by
the impact on financial markets globally is something that will have to be watched.
Right. So, Ashish and Neelkanth, like, we are coming to the end of this section now. Whatever we've spoken till now is outright depressing, quite honestly, right? Like, US not looking good, China, which did very well in the last cycle, not looking good, Europe not looking good, Japan, neither good nor bad. You said it's not a outright collapse, but it is perhaps is the next decade the lost decade for the world, or is there some source of redemption somewhere?
So the first is, I think cyclically we are going to do better, meaning that, so there's always a 6-month view and a 6-year view, a 5-year view, right? So see, there are business cycles, and these are called driven by inventory cycles. So what happened when the US printed a lot of money is that demand, and everyone was locked in, demand for goods went up, and what we call the bullwhip effect played out, right? So in bullwhip, what happens is you move your hand slightly, the end of the bullwhip moves at 300 kilometers an hour, right? So same, end demand moves slightly, the upstream, the metal suppliers and all of that, the demand. You must have seen shipping rates went up 5 times and all of that, right? Now, as that unwound, everyone was stuck with a lot of inventory, and then for a while it seemed like, in India also, textile companies got order cancellations, no one was buying, shipping rates fell back by 5/6, they became 1/6 of what they were at the peak. Now what we are seeing is that a restocking cycle will start. It will not be a very extreme restocking cycle, because end demand is weak still, but it will support the global economy.
Right.
So it will not be an outright collapse. And at the same time, I must say that there are economies like India, those in ASEAN, like economies like Indonesia, some of the countries in Africa, which are still too small to manage to affect global GDP, but there are pockets of strength, and there is a lot of interesting and exciting growth happening there.
Right. And from a markets perspective, Ashish, how do you see this?
No, I think markets, there is some degree of challenge, because what has happened this time around is that typically central banks start cutting rates or start monetary easing when leading economic indicators turn downwards, right? So you have kind of 3 kinds of economic indicators. They are leading, concurrent, and lagging, right? So as soon as the leading economic indicators start coming down, that means the GDP slowdown is 6 months, 9 months away. The central banks start to act, right? This time around, unfortunately, we are already about 12, 13 months since the leading economic indicator started turning down, and the central banks are still raising rates.
Right.
Right. Of course, it can be said that rates are being raised from very low levels.
Right.
Right. So maybe the challenge is not that great, but the move up, say in the US, has been 500 basis points just in 12 months. Right?
Absolutely. And rates are now historical, not historical highs, but very high, right?
Yeah. So I think that is what we need to kind of be mindful, because once, even if they stop raising rates, right, or even if they start, there is always going to be a lag, right? As the lag was there when they have raised rates, lag with which typically 12 to 18 month lag by which it starts to reflect in terms of slowdown. Correct. Even when they start cutting rates, it won't be immediate, right? So I think that's what we need to watch out for, because if there is a large kind of pause, so I think the consensus is that this or the next would be the last rate increase by the Fed. But I think the bigger question is, what is the time when it cuts the rates next, right? So is it higher, but for how long, right? So I think that is the biggest question that the market is debating till now. I think given what's happened to the inflation prints recently, I think market was expecting that rate cuts will start coming from first half of next year. I think now that view is changing, and markets are kind of starting worrying that we will have high rates for longer.
Understood. So moving on to perhaps a little bit of optimism in our last topic for the day, which is India. India seems to be in this Goldilocks position, and so great to hear from you, Neelkanth, on like macro-wise, how does this look, and how sustainable is this story?
No, so I'm quite positive. I think we will not be immune to the global slowdown, and some of that is starting to show up. Right, so we are seeing like IT companies reporting weak numbers. We have seen some of the exporters, like in textiles, struggling a bit. I think metal companies will also start getting into some serious problems, but some of them. But on the whole, there is from a 5-year perspective, medium-term perspective, I think there is significant room for optimism. I'll summarize it into 3 parts. Right, so using the same framework of capital input, labor input, and total factor productivity. So on the labor side, less said the better. I think we all know that India's demographic dividend is now going to play out over the next 25-30 years. It also kind of puts a gun to our head that look, we have to grow whatever we can in the next 30 years. So therefore, we should not be happy with 7% growth. We should target 8-9% growth, because just like China and Thailand are at risk of growing old before they grow rich, if we don't become a rich country by 2053, we will also run that risk of growing old before we grow rich. I mean, it's too late for all of us here, but I think as an ambition, I think we should target that. So the demographic, so the labor force growth with improved quality, because education number, if you look at some of the education indicators, they are phenomenal.
Right.
So the percentage of people who are in the 18 to 24 age group who were either in college or had graduated has sort of become more like 25%, versus being a fraction of that just one generation back. So there's a remarkable, there's a long way to go, but very significant improvement. So labor input should grow. TFP, total factor productivity or productivity, is growing because the state in India, and it's not just the center, but the states also are realizing that you need to let businesses flourish. Right? And that's very clearly visible in many of the government policies. You look at schemes like the PLI schemes, at least in design. Some of the implementation issues are now emerging, but at least in design, the desire to create champions was very clear. You look at the pro-business policies of many state governments. The fact that state governments like UP and TN and Maharashtra and Gujarat, they all have $1 trillion GDP targets, is actually quite positive. So I think labor growth can be 1%. TFP growth, and you'll be surprised to hear this, between 2014 and 19, when China's TFP was falling at 1.5% a year, India's was growing at 2.5% a year.
Wow.
Right. So the reason why our economy slowed down before COVID was because of shortage of capital formation.
Right.
I'll come to that at the last. So even if you assume not 2.5 or 2% growth, so you have 1 plus 2, 3%. Right. Now what happens to capital formation? Capital formation is almost by definition cyclical. Right. So there are cycles where you deleverage, there are cycles where you leverage.
Yep.
Now, not only are corporate balance sheets the most delevered we have seen in 15-20 years, but even the lenders' balance sheets, right? The bank balance sheets in terms of assets to equity ratio, the non-banking finance companies' assets to equity ratio. So they are all at very low levels. So whenever risk appetite improves, see, right now everyone is worried about the world and all of that, so therefore I think credit growth is not as fast as it can be. But there is enough fuel in the tank that whenever this recovers, that a lot of growth can be financed. The most important change that is happening is the real estate cycle. So remember that for most households, house is the biggest expense in their working life. Right? So for example, if you add up the amount you spend on food and clothing every year and multiply that by 30, at least for people living in Bombay, it'll still be a fraction of what you end up paying for a house.
Yeah.
Right? It's the biggest purchase that you make. And so if the housing market slows down, it slows down the overall economy. And we are coming out of a 10-year slump. What we are starting to see now is, the last 2 years have been decent for the real estate market, actually pretty hot for some of the stocks, but volumes inventories have been cleaned up. Now we are starting to see construction of houses by developers. We are also starting to see some commercial real estate getting developed. And what has been most heartening in the last 3-4 months is that the independent home builder, IHB, has also started to come in, right? So basically, we are seeing good demand for PVC pipes, for tiles, and which means that it's not just the big developers, but people building their own houses. So as this picks up, and cement volumes as well have been doing well. So this is a very important cyclical boost to capital formation, and which is why I'm very positive on the medium-term outlook for India.
Great, thanks, Neelkanth. And so again, Ashish, from the markets perspective, Indian markets have done incredibly well.
Yes.
And so again, your perspective on this, and how do you see this kind of?
No, I totally agree with Neelkanth that I think, again, taking the analogy to how we discussed China, that there's a balance sheet problem there, and in India, we don't have that problem, right? And in fact, I'll extend, we don't have a balance sheet problem on the corporate side, we don't have a balance sheet problem on the bank side. I think, in a sense, we don't have a problem with the country's balance sheet as well, right? So, because historically, India has these challenges of twin deficit, the external account is weak, forex reserves. So, if you see $600 billion plus of forex reserves for the RBI, probably rupee appreciation is a larger headache rather than a rupee depreciation today, right? I think fiscal side, yes, the deficit since COVID has again moved up, but actually you see the tax to GDP ratio has improved, and the fact that fiscal deficit is high is primarily because the public investment in capex has really gone up. Right. So I think the markets are recognizing the fact that economy's balance sheet fundamentals are quite strong, quite resilient. I think over the last 2 years, it's also become evident that India has been one of the few exceptions to the global inflation spike as well as the global slowdown. Right, it's been quite interesting to see, and it's not something I've seen in my 25-30 years, that inflation in India running below US inflation.
Yeah.
Right. So I think, and of course, as we have discussed, because the global central banks printed so much, entire developed world inflation was much higher, and actually inflation in India and therefore rates in India are no longer at a much higher premium to global rates, right? So that augurs well for capital formation in the country as well as consumption in the country. Having said all of this, the fact is that the markets have been on a tear over the past couple of months in particular, and they're no longer inexpensive, right? If you look on just a simple earnings multiple basis, the market is trading at over 20 times earnings. In fact, one statistic that is kind of even more pointed is that if you look at companies over the $1 billion of market cap, there are 450 such companies in India, a third of them today have a P of more than 50 times.
Wow.
Right. So I think we have to be careful about what kind of growth we are building in. Yes, India is more resilient, but we have to see it deliver on this earnings and promised earnings. Otherwise, there can be significant kind of correction because the multiples are very high.
Right.
Right. And so that is something we need to watch out for.
Right. And Ashish, the other thing is this kind of the emergence of this retail consumer or retail investor, right? And
yes.
And kind of the reduction of dependence on FII.
Yes.
Like earlier, when you
yes.
know someone in US would sneeze, the Indian markets
yes.
would fall.
Yes.
But that seems to have changed. So some perspective on that.
Oh, absolutely. I think what we saw in the last 2 years, I think in aggregate there was $40 billion of foreign outflow. And even in times of GFC, the outflow was actually less than half of this, and we saw what was the reaction in the market.
Yeah.
Right. But I think there has been great asset reallocation among the domestic saver. And I'm actually purposely not calling it as an investment, but asset reallocation. Because in the AMC, I'm consistently seeing this when I meet our distributors, when I meet our partners, that everyone is going out to investors and not telling them that, okay, you buy the tech fund now or the banking fund now, etc. They are just telling people, okay, you do SIP in this fund or you do SIP in this fund,
Right.
etc. So people are actually just allocating more money to equity than what they have in the past. So I think it's not something that is just a phenomena that has come about because there has been a rally in the market. I think there is a decided shift towards allocation to equities, and I think that will actually continue to build, and that underpins the PE premium as well. We have seen in many other emerging markets, and Malaysia is one particular example, that as a larger part of domestic savings got allocated to equity, consistently the market moved to a higher P band. It's not that market will not have a cycle.
Of course.
It will have a cycle, but at a higher range
Right.
than earlier.
Right. Great. Final question to both of you actually, which is, India has had this multiple episodes of promising to be the bird of gold, and then we are also very popular for hitting self goals. So, like, what's the risk? What could go wrong? Neelkanth, maybe we start with you.
No, I think the most important is the energy prices. So, you see, in history, there are very, very few large economies that have grown sustainably without controlling their access to their own that dense energy. Right? So, GDP growth is very tightly linked to consumption of dense energy forms like oil, coal, electricity, and so on and so forth. And we are currently importing 48% of our dense energy needs. So if there are, if the global energy prices go up for some reason, right now they are well behaved, we suddenly will be forced to slow down. So I think that's the biggest risk. The second risk is on the fiscal side, that a lot of the macroeconomic, if you have macroeconomic stability, which means relatively stable inflation, relatively stable interest rates, it allows people to think forward, right? So if you are living hand to mouth, every company is thinking next 6 months, nothing big can be achieved. If you can expect steady inflation, steady currency, steady interest rates for the next 5-7 years, then companies can start investing, planning big time, right? And all of this comes from fiscal discipline. If regimes, and we are starting to see that in some state governments, start becoming fiscally profligate, then some of this stability can be put into question mark. As of now, I think it's less of a risk because state deficits, because of Article 293 of the Constitution, are effectively capped. But if we start seeing indiscipline at either the center or the state, then we may see 1 or 2 years of rapid growth, but then it very quickly fizzles out.
Ashish?
No, I think I'll go with the second point Neelkanth made, and I'll say complacency, right? So whether it's complacency in the fiscal policy or the reform agenda, etc., because there are lots that still needs to be fixed, right? I think we are on the right path. I think I'm less worried about global prices because all we have discussed about the outlook for global growth, I think global commodity prices will correct sooner rather than later, and we don't think it can stay elevated for a long period of time. I think what we need to focus on is our internal dynamics. I think we need to ensure that we don't kind of move away from the ease of doing business, the reform paths that we are on. I think sometimes it happens that we do best of our reforms when our backs are against the wall, and when things are better, we feel there is no need for action. But I think we continue to need affirmative action for sustained growth.
Fantastic. Great. So just to kind of in conclusion, it just feels like we are at a important point in time in the global macroeconomic order, and it feels like this is the beginning of something that is going to evolve over the next years or maybe even the next decades, and feels like India is positioned in the right way here, and we have, as you said, the next 20-25 years to just kind of make up for it. Sounds like a great conversation. Thank you, Neelkanth, and thank you, Ashish. It was a fantastic conversation. I hope you enjoyed as much as I enjoyed learning from you. Thank you very much.
Thank you. So